Hi traders, this is Thomas from Easy Trading Blog. I wanted to show you in this video how I try to find good trading setups for trading options. So let's start. You don't need any fancy software or you don't have to pay anything. You just need an internet connection and of course a brokerage account. So my first website I usually go to is cboe.com, which is a website of the Chicago Board of Options Exchange. Amongst the tools on this website you find something called Volatility Finder. You just click here on the Volatility Finder link. This opens a new site. Then you have to go here to click here, and then this opens a new site where you find the Volatility Finder. Volatility is very important when you're trading options. I usually try to sell options because as an option seller you have probability on your side, and as an option seller you always have to look for stocks or options with a very high volatility. The higher the volatility, the higher is the premium you can collect on the option you are selling. So now we are here in the Volatility Finder tool, and we are screening the market now here for implied volatilities. As an option seller, we want to scan the market for the highest volatility. Click just here, and now let's have a look at this table. Actually, I already made a pre-screen to be able to make this video as short as possible. And the stock I found here, which looks very interesting to me, is SNSS Pharmaceuticals, SNSS. As you can see here in this tab, the implied volatility is currently at 360%, which is very, very high when you compare it to the historical volatility on the last 30 or even 90 days. So SNSS is the symbol we want to have a look at. The next step I'm making is now I go to Yahoo Finance to look whether there is an event ahead which may be the reason for the high volatility. Usually when a company is to release earnings, there is a very high volatility because the market is not very sure whether the stock will go up or down within the next days after the earnings event. But here in Yahoo Finance on the calendar tab you can see there are no upcoming events, so there is no reason to fear bad earnings or something like that, which is very important. The third steps now I take is I go to a charting tool. I usually take TradingView, tradingview.com. You can find free in the internet. And this is a daily chart now of SNSS Pharmaceuticals, and now let's have a look about what the technicals are on this stock. We can see that price was moving in a trading range between 650 and 850 during the last 2 months, and currently on Thursday afternoon the stock closed below the lower Bollinger Band and even closed with a nice doji candle. If you know a little bit about technical analysis and candlestick patterns, you know that we can now expect a move to the upside, maybe until the 20 SMA, which is in the middle of the Bollinger Bands. Actually, we see that the price is not very likely to hit 5 or even 4 or $350. That's important for our trading setup. I marked the expiration date of the option I choose. It's here on the 18th of October. Actually it shows the 20th because this is a weekend, but I just wanted to show you how close we are now to expiration date, because this is important for us as option sellers. The fewer time there is till expiration, the higher the decay of the option premium is. So then I looked at my brokerage account, what kind of options we do have. And there I found a put for a $5 strike, which expires, as already said, on October 17th. The $5 put sells for $1.55 currently. What does this mean? Let's have a look at the chart again. On the chart you can see the strike price is well below the current trading price. The current trading price is $6.59, the strike price is $5. So what does this mean? We are selling an option which gives somebody else the right to sell us 100 stocks of SNS for $5 a share. He would only do so if the stock price will be below $5, because otherwise it wouldn't make sense. If the stock price is still at, let's say, $5.50 or $6, it wouldn't make sense for somebody else to sell us the stock for $5. So that's what we expect. We don't expect a move below $5 until expiration day on October 17th. If price will not close below $5 within the next 2 weeks, we will collect the whole premium of $1.55, or since one option stands for 100 shares, we will collect $155 for a possible risk of $5 times 100 shares, $500. That's a gain of nearly 31%, and if you annualize this, during 2 weeks, 31% means more than 750% annualized gain. That's a tremendous gain we can make on this trade. In the worst case, what could happen is that the stock moves even below our strike price. We would have to buy the 100 stocks, the 100 shares of SNSS for $5, but since we collected $1.55 for each share, our break even is only at $3.49. I already calculated the commission in, so the break even price for me in this case would be $3.49. This means that the stock had to fall nearly 50% within the next 2 weeks before we are really in a bad condition and didn't even close over break even. So that's a very high probability setup, and when we look at the delta, where have I got the delta? I'm not sure, but the delta is about 21%. This means that the probability of this trade for closing below $5 is only 21%, and the probability of closing below break even is even lower. So it's a very high probability trade with a very good possibility that we can collect $155 for one option sold within the next 14 days. And that's what I'm going to try to put as a trade. The market opens in about 20 minutes, and I will see whether I'm able to put this price and sell the option.